All right, so a lot going on in the market. You recently upgraded your equity targets for the U.S., and at the same time, you increased your bond yields forecast. We've seen a big spike. So I don't know where your forecast was before we saw this big spike, but do you see more upside when it comes to yields? And more importantly, what does that mean for the equity markets?
Yeah, so I believe we've changed our forecast a couple times over the last quarter or so. A lot has really been happening in the markets. I think on the yield side and on the bond side, there's always risk to the upside, but particularly now. We've been saying there's risk to the upside, for a couple months now, but particularly now with, the headlines you just discussed, there's risk there for investors. And why is that important for the investors that we cover? Well, historically, they were looking for some of that protectionism from bonds. And a lot of investors that we cover at Goldman have been looking for ways to add diversification and what they call crisis risk hedges to the portfolio. And a part of that would be longer duration bonds.
Okay. Well, I think a lot of people want to know, we know the bonds are pretty volatile right now. The one big beautiful bill, kind of bringing out those bond vigilantes. But what does this all mean for the equity market? Can we continue to see growth in the equity market with so much volatility in the bond market? And if so, what areas do you see the potential for that?
The important thing about how equities are going to be affected on the bond side is the steepness and the rate of steepness in the changes of bonds. It's not necessarily, it's almost like, the frog boiling in water. If it's super rapid, it's going to affect equity prices just like we saw a couple years ago. But if it's more gradual, then perhaps that won't happen. We do see further upside in equities for this year. We just revised our GDP targets fourth quarter from 0.5 to 1%. We see earnings growth. We, as you already know, we were surprised to the upside on earnings last quarter. And then for next year and the year after, 2026, and we see 7% earnings growth. So we still see positive momentum in the equity markets. And in fact, on some of the big Mag 7 tech names, we actually see buying opportunities now based on where they've come in since the beginning of the year. And I will also mention there that while we expect they will outperform the broader market there on an earnings basis, that margin is going to be smaller than it was maybe than you saw in 2024.
Okay. At the same time, it seems like you're seeing some short-term volatility when it comes to the equity markets, maybe even a pullback, because you say right now there's some attractive hedges. So what hedges are attractive right now in this market?
So on the short-term volatility, so volatility did come in. So it's looking better. It's always like the right time to buy insurance on your house isn't necessarily when your house is burning down. So you might want to be thinking about it in advance. But it depends on what you want to hedge specifically. We think on the shorter term, the events you kind of want to look for are maybe around labor numbers, since that's going to be a really key hard-dated decision point for the Fed. And maybe you want to think about equities down combined with dollar down or yields up type of cross-asset hedges.
You mean shorting? How are you hedging these things?
So where we see clients thinking about implementing this, and I'll point out that for the larger institutions that we cover, they're not necessarily putting on direct hedges. They're thinking about hedging through their asset allocation. For other institutions, maybe individual investors or family offices, they may be putting on hedges. But yes, the premise would be that the risk is equities to the downside, not necessarily equities to the upside, although we just published a couple papers on how the tails on either side of that distribution have come in quite a bit. There's a narrow path versus where we were thinking a couple of weeks ago. There was a wider path for dispersion there.
We've seen a big bounce off the April lows. A lot of people have talked about institutional investors kind of being off sides, needing to catch up to the rally. I want to go to your wheelhouse. One of them is pensions, obviously very big institutional investors. Right. Where are they at after this big rally? You also said they're very concerned about a real rate of return with a lot of macro volatility. So what moves do you see big institutional buyers or sellers, whichever way it goes, what kind of moves do you see them making?
Well, to your real return comment, that's a real thing. Oftentimes, we as investors forget that there can be a decade of lost real returns. And real returns matter, especially when you're paying out pension benefits, some of which might be tied to COLA or real sorts of metrics out there. So that really matters. Even if you're making money on a real basis, you've got to take that into account. In terms of where they're moving, we just got off the Milken conference, and I will say a lot of those conversations were dominated by talk about tariffs and talk about geopolitics. But there was actually very little movement that we saw in the equity markets, maybe at the margin. From our ex-U.S. investors, we've seen more movement, but they've been having to deal with currency hedging and what's happening in their local market versus the U.S. market for quite a bit longer than investors here, at least for the last decade, have really had to think about it. So while we have seen questions about where should we be looking ex-US, where should we be diversifying. It's really only moving at the margin. It hasn't picked up quite yet.
Really?
Yes, it hasn't. And I would say last year we did see more requests for proposals going out into the market on developed markets and emerging markets ex-US. We still got some time in the year to see what happens there. But there hasn't been really any great moves. And part of that is because a lot of institutions are still suffering from this liquidity problem. So they don't have a ton of margin to move quite yet.
All right, so it sounds like the whole Sell America thing might be a bit overblown, at least when it comes to big institutional buyers. They're still looking here in the U.S.
Well, I don't think the Sell America thing is necessarily completely valid either. When we think about the U.S. still has a positive growth rate, and on a risk-adjusted basis, it's still a pretty good place to be, particularly on an ROE basis. That doesn't mean you shouldn't diversify and you shouldn't be looking elsewhere, particularly in sectors or themes that you like that might be cheaper elsewhere.